Welcome to the Screencast on Analysing Receivables. Accounts receivables is the sum of money that is owed to a company by a customer who has not yet paid for a service that has been performed or a good that has been delivered. This means that customers have made a purchase on credit. Analysing accounts receivables is important as a receivable essentially represents an uncollected sale and provides insight into a company's financial position. Companies are generally interested in how efficiently they are able to collect these receivables, as they are the lifeblood of a company's cash flow. For the following examples, I will introduce Molly, who owns her own construction company. The horizontal analysis calculates both the dollar and percentage change in an account balance, defined as the current year balance less the prior year balance. Molly knows her total accounts receivable for the years ending 2019 and 2020. To perform a horizontal analysis, the prior year receivables balance is deducted from the current year balance to give a dollar change of $350. The $350 is then divided by the prior year's balance to show that the accounts receivables balance has increased by 37%. The method of vertical analysis is used to find and compare the accounts receivables balance as a percentage of assets. Molly knows her receivables and total assets for 2020. The accounts receivable of $1,350 is divided by $30,000, which is the total assets. This exemplifies that approximately 4.5% of Molly's assets were receivables in this year. This method compares a company's credit sales to its average receivables balance during a given period. The higher this ratio is for Molly's construction company, indicates that it takes her longer to collect these receivables. If Molly divides her credit sales by her average receivables, it is evident that she has an approximate receivable turnover ratio of 26. This means that Molly collects her receivables approximately 26 times in a period. The days in receivables ratio follows on from the receivables turnover ratio, where a company's ability to generate and collect receivables in days is expressed. This equals 365 days divided by the receivables turnover ratio, disclosing that Molly collects receivables once every 14 days. The last ratio that can be used is the allowance ratio, which determines the amount of receivables that are expected to remain uncollected into the future. In Molly's instance, this can be revealed by dividing her allowance for doubtful debts by her gross receivables. This means approximately 9% of Molly's receivables are expected to be uncollectible into the future. Thank you for watching the Analysing Receivables screencast.